Hello, my name is Brent Kochuba and I am the founder of SpotGamma. SpotGamma offers traders and investors daily analysis on the stock and options markets. We are one of the leading providers of market analytics and have been featured in top publications like the Wall Street Journal and Bloomberg. If you need a primer on equities or options, please visit videos 1 and 2 in our educational series where my co-founder Matt covers the basics. Before we dive into the Greeks, here at SpotGamma, our goal is to provide you with unique information around stock movement based on our valuation of the derivatives markets. SpotGamma is an information-only site and nothing contained in any of these videos constitutes investment advice. If you're going to make any investments, please consult a professionally licensed investment advisor before making your independent decisions. Today we'll be covering key topics which include the inputs that drive options pricing, the definition and role of the Greeks, the interrelationship between these factors, the importance of understanding time and volatility, and an example of how to apply this knowledge to construct an options trade. So let's get started with the inputs that go into options pricing. Here on slide 3 we're going to cover the basic of options pricing. Using plain English, let's start by understanding the following terms. Stock price. The stock price is the current price of the equity for a company at a specific time. Strike price. This is the set price at which an option contract can be bought or sold when it is exercised. Choosing the right strike price is important when establishing an options position. This is a topic we will cover more in depth later in this discussion. Dividends. Some companies pay dividends, usually quarterly, and this value is imputed into the overall options model. Risk-free interest rate. The risk-free rate is the minimum amount you would expect to return from assets in the market. This value is linked to the Greek rho covered in the next slide. Time to expiration. This is the time measured in days between today and the date the option must be executed or it goes away. This value has an effect on the Greek theta covered in the next slide. Volatility. This relates to the amount of expected fluctuation in the stock over a period of time. If volatility is higher, the option price will be higher. The effect of volatility on options is measured by the Greek Vega covered in the next slide. To get an options price, all of these values are taken into an options model like Black-Scholes, which then creates as its output a specific price for a specific call and put. It also calculates the Greek values, which we'll be discussing today. Now that we've discussed the inputs to an options model, let's talk about the Greeks an options model derives. Let's start with rho, which is a measurement of the risk-free rate's impact on the options price. This is a relatively straightforward calculation, and we will not spend much time on it throughout the rest of this video. Next, there are theta and vega. Theta is the measurement of an impact on an options price due to time, and vega is the impact on an options price relative to volatility. We'll dive more deeply into these concepts when we get closer to our example. Lastly, and where SpotGamma focuses much of its efforts, is in delta and gamma. Delta is a ratio which links the options price to the stock price. Gamma is a derivative of delta, which is the dynamic measurement depicting the rate at which delta changes relative to movements in the underlying stock price. Let's look at an example using the Black-Scholes model and how these Greeks play an important role. Here on slide 5, you can see that we've entered some inputs into a Black-Scholes calculator. In the top section, we can enter some key inputs, and then the calculator produces both the options value along with the Greek variables. We're going to use this sample output to discuss both delta and gamma. It's worth noting that most trading systems run these calculations in real time through each trading day. Options pricing is a dynamic endeavor as stock prices, time, and trader sentiment are constantly changing. This Black-Scholes example is valuable because it shows us a snapshot in time which we can further examine. With that, let's examine our first Greek, which is called delta. Now we're going to talk about delta as defined by dollars. The official definition of delta is the rate of change of an option for a $1 move in the underlying stock. As we show here, a call option with a delta of 0.50 will gain 50 cents for every $1 rise in stock. Now, as my colleague Matt explained in an earlier video, put options are a bet that stocks will decline. Therefore, as you can see in the green box, puts carry a negative delta, and they will lose value if a stock rises. Now, on the other hand, if the stock price declines, the call option would lose value and the put option would increase in value in accordance with this delta value. The screenshot here shows an actual options market portrayed in the trading software offered by the broker TD Ameritrade. You can see the headers represent the Greeks we've initially described, delta, gamma, theta, and vega. These values are calculated by TD in real time. To place delta into practice, you can look at the table to see the values for some listed options on the stock ACB. For call options highlighted by the green box on the left side, you can see that the options delta increases as the strike price decreases. On the left-hand side of the montage, you can see that the Greeks and the prices are available for each call option. For call options, where the current stock price is above the option strike price, investors use the term "in the money" to describe those options. Conversely, for the times that the current stock price is below the call option strike price, investors use the term "out of the money" to describe those options. For put options, as you can see on the right in red, it is the opposite. Where current stock prices are below the strike price, those options are in the money. What is important to know is that options that are in the money have a higher delta value. With stock at ACB at $9.60, you can see that the delta for a $9 call is 70, and that is roughly double the value for a $10 call, which is 35. Next, we will cover the relationship to and the definition of the option Greek gamma. Now that we have discussed delta and understand it is the ratio of the movement of an option relative to the underlying stock, we will move to gamma. Gamma is defined as the rate of change of delta. This may sound confusing, but think of it as a metaphor. Consider for a second that delta is the constant speed of your car. At any point in time, you may be driving 55 miles an hour down a highway, and again, this is a fixed speed. Now imagine that you need to pass another car and you speed up to 60. That rate at which you increase your speed, which is called your acceleration, is equivalent to gamma. As delta is a fixed ratio of shares for a given stock price, gamma explains how quickly your ratio of shares would change for a given change in the stock's price. Now, when you buy options, be it puts or calls, you establish what's called a positive gamma position. This means that you profit when the underlying stock has a large move. If you were to sell short an option, you would then have a negative gamma position. This implies that you want the stock to have very little movement. This concept will be repeated throughout the discussion and detailed in later examples. Now let's take a look again at the same options montage to further illustrate the relative effects of gamma on pricing, just as we did with delta. After that, we'll explore the other relevant Greeks. To revisit the options montage from the delta example, let's begin by reviewing that delta is largest for options which are in the money. However, gamma works in a different way. Gamma, again being the rate of change of delta, is highest around the current price of the stock. This is marked by the label ATM, which stands for at the money. So, the farther you go in either direction away from the current stock price, regardless of if you move in the money or out of the money, the value of gamma declines. Since gamma changes the most around the current stock price, the delta values will also be more strongly affected and change around the current stock price. This rate of change for both delta and gamma are key to SpotGamma's modeling process and discussed in our next video. Let's now look at another chart to further illustrate the relationship between delta and gamma. Now let's discuss the relationship between delta and gamma. As a trader or investor, you can see that trading platforms provide you with a montage describing and detailing the Greeks relative to stock prices on a real-time basis. However, the values shown to any trader are a snapshot in time and therefore essentially static. In our view, the power of options is unlocked by understanding the dynamic relationship between gamma and delta. Earlier, when defining gamma, we explained that gamma is the rate of change of delta. There's a common saying in the options industry that gammas manufacture deltas, and we'll explain that here. View the data table on the bottom right, which depicts the change in delta and gamma for a given move in the underlying stock. With the stock at $7 per share, let's say you buy a $10 strike call option paying $1 per contract. Again, this represents 100 shares of stock. This option has a delta of 35 and a gamma of 4. Now, how do we determine the theoretical value of this option as the stock price moves to $8? To answer this question, we start with what we know. We know that the delta is the change in option value for a $1 move in stock. So our new value is calculated by taking the current value of $1, adding 35 cents, or the option delta. This means if the stock is at $8, the option value should increase to $1.35. However, we cannot ignore gamma. Next, since we own the $10 call, when the stock moves, we need to update our delta value by factoring in gamma as the stock rises from 7 to 8. To estimate the delta of this option when the stock hits $8, we simply add the gamma value of 4 to the delta value of 35 to get a value of 39. This tells us that a stock price increase makes our $10 call option rise by 39 cents as the stock goes from 8 to 9. The big takeaway is that if you bought this $7 stock and it went to 8, you make a 14% return. If you bought the $10 call when the stock is at 7 and then the stock goes to 8, you make a 35% return. This levered return is driven by gamma, and it's one of the main reasons a trader would choose to buy options rather than stock. With this, we're next going to address the concept of theta, which represents time and its impact on options prices. While there is a critical relationship between delta and gamma, there is an additional dynamic we must add in. That is the role of time, which is generally defined by the number of days until your option contract expires. When you're purchasing an option, you are essentially long gamma, which means your option has a positive gamma position. As we just illustrated in the previous slide, gamma is what drives the price increase of your option when the underlying stock moves. However, nothing in life is free. And in this case, your cost for owning an option and being long gamma is called theta, or time decay. With each day that passes towards expiration, everything else being equal, your options contract will lose value due to theta, or time decay. When purchasing an option, you are essentially going to assess your potential profit, which is gamma, and this offset to own the option, which is called theta. In the next slide, we're going to show this concept through actual examples. Take a look at the options montage for Tesla, which is below. With the stock trading near $647 per share, on the left side you can see the data for the 650 strike call, which expires tomorrow. Now compare this to the right side, which shows a March 2021 650 strike call. That expires in 3 months. For tomorrow's expiration, the options price is $14.50, which would cost you $1,450 in total. Recall that there's a 100 multiplier. The option has a delta of 47, a gamma of 9.6, and has a theta of 4.8. If the stock does not move at all, this theta level implies you will lose $480 due strictly to time decay. Again, there's a 100 multiplier, so you take 4.8 and multiply by 100. That is obviously a very expensive short-term play due to the fact that the option expires tomorrow at the market close. However, that option has a very high gamma, 9.6. This means it could have a very large payout with a rapid stock move. Let's compare this to an option with more time to expiration. That same strike, 650 for the March 2021 call, is $9.80 for a total cost of $9,800. It is a delta of 57, which is a bit higher than the other option. However, the gamma is only 1.6. Compare that to the 9.6 value for the other option, which expires earlier. The theta is only 50, which infers that it has a $50 per day of time decay. This is obviously substantially less than the $480 worth of time decay for the option that expires tomorrow. So as you can see from this example, the near-term option has a very high gamma but very high theta. While the cost to purchase this option is much less, $14.50 versus $98, you're paying a much higher theta to make a more levered bet. In other words, the longer dated option costs you less time decay but also earns you less for a given move due to its lower gamma. For purposes of this session, when considering which option to trade, there is no right or wrong answer. There are a myriad of options trading strategies which seek to exploit all these various aspects. Your best choice is likely to be made by assessing how much you think the stock may move over a given time period. With that, we're going to shift gears and talk about Vega as related to volatility. At the outset of this presentation, we described Vega as one of the outputs from our Black-Scholes pricing model and how it relates to volatility. Specifically, Vega is defined as an options price change for a 1% change in the implied volatility of the underlying asset. The farther away an option is from expiration, the higher an option's Vega is. That is, options with a larger time to expiration are more sensitive to a change in implied volatility. Vega also has an impact on the other Greeks. As you can see in the chart here, higher volatility increases the gamma level on options that have a strike price which are further out of the money. This means that out-of-the-money options become more reactive to changes in a stock's price. For many traders, this is an important metric, but first we need to answer a more critical question. Just what is volatility for the life of a given option, often referred to as implied volatility? The concept of volatility and its impact over the lifetime of an option is the final key area of our review of the Greeks. Volatility is a common trading phrase, often associated with stock crashes, but volatility simply means movement. When you buy an option, you are essentially expressing a view that the stock will have a lot of movement before the contract expires. Now, how do you gauge how much movement a stock may have? Let's look at an example to review the impact of volatility on Tesla's stock. The upper pane of the chart here shows Tesla stock, which is currently trading at $670 per share. Now let's focus our attention to the lower pane, where you will see a single yellow line which represents realized or historical volatility. Realized volatility is simply a way to measure how much a stock has moved over a given time period. As part of an overall investment approach, many investors will analyze the history of an individual stock's movement as a potential indicator for how much it may move in the future. Knowing how active a stock has been in the past is important to estimating how much a stock can move in the future. So, the big takeaway is that when you are trading an option, whether a call or a put, volatility is a key component that must be measured and factored into your decision. Volatility strongly affects the pricing of options and your potential to generate positive return from options trades. Now that we have a sense of how much movement a stock has had in the past, let's turn our attention to the next important concept around volatility, which is what the market sees or expects as future volatility. To ground the point from the last slide, volatility has a large impact on Greeks and options prices. Having spent time covering historical volatility in the previous slides, we will now apply these concepts towards assessing future volatility. The expected movement of the stock for the remainder of the option's life is at the core of an option's price. Recall that volatility is a key input in our options pricing model. The future volatility can be referred to as implied volatility because it is the expected volatility a trader will use to calculate an option's price. Consider our Tesla example and imagine you are looking at options that expire in 3 weeks. Rather than it being in the middle of August, during a time when little news is expected, we know that earnings is coming out in 5 days. This event is important and gets calculated into the implied volatility, and consequently it has a meaningful impact on options prices. While the majority of our discussion has been about technical analysis, all investors should be aware of expected news events such as quarterly earnings, as they can have an additional effect on volatility which significantly impacts the price of options. Now let's take a final look at volatility as an expression of the overall options pricing in another options montage. As a final takeaway, we want to show you these two options montages which clearly reflect the impact of implied volatility on the price of an option. In the top panel, Tesla stock has been on an absolute tear based on described enthusiasm for the electric car manufacturer. As a result, their stock has a very high implied volatility because investors expect that stock movement to continue. This results in options which have a high cost relative for calls and puts. On the other hand is Colgate, which makes things like toothpaste and mouthwash. They are not expected to revolutionize the economy, and investors do not anticipate a lot of stock movement in their future. Thus, their options are much less expensive on an apples-for-apples comparison basis with Tesla. This should reinforce the concept that higher implied volatility means higher options prices and must be considered when buying or selling options. The concepts discussed in this video are key to understanding the options market and how they in turn impact the stock market. Traders and investors use options for a variety of reasons, many of them relating solely to these Greeks. I'd like to thank you for joining us on this explanation of how options are priced and the impact of the Greeks. In our next and final video, we will reveal how SpotGamma analyzes all of these dynamics. Before we go, we want to remind you to go to SpotGamma.com right now and start a free 5-day trial. Each day we share a unique approach to analyzing markets with thousands of subscribers just like you. We look forward to seeing you on our next video.